Hello world, welcome to Building Black Wall Street. This video is going to be a continuation of the last video I did on what is investing, and I briefly spoke about a margin of safety and pointed out how Graham said that was the three most important words in terms of investing. So I'm going to delve in further to that and also point out how you can really get something of value in the stock market and the type of analysis necessary to put yourself in a position to really be investing and not speculating. I use Walmart as an example, so we're going to look at some of the financial information so we can get a clear idea of how to go about trying to value a company. This is some of Walmart's information from the CNBC app, and we're going to use it just to get an idea of how to go about trying to value a company. We're going to be zeroing in on some specific areas, like if you look under key stats, we're going to look and focus on the market capital, which is $213.709 billion. And the reason that's important in our analysis is because that's around what Walmart, the company, would be selling at. Say if another company or somebody wanted to purchase it, they would have to pay around that ballpark. Now, usually companies sell at a premium, so they might end up paying almost $250 billion, even though the market capital is $213 billion. Now we're going to look under the ratios and profitability, and I want us to focus on two particular areas. Number one, Walmart's annual revenues is $484 billion, and their EBITDA, or earnings, EBITDA, which stands for earnings before interest, tax, depreciation, and amortization, is $33 billion. So the EBITDA, to me, what really stands out is their profit is a little bit more than 10% of their market capital. So their profit is more than 10% of how much the company would sell for, or around 10% if we factor in the premium that Walmart would sell for if somebody wanted to purchase it. And if we look at all these numbers together, we can kind of conclude that Walmart's revenues is around $250 billion more than their market capital. I didn't pull out a calculator because I just want you to get the gist of how we would start to think about the value of a company and use their financial information to conclude whether we're getting a company under its intrinsic value. Now, when we think intrinsic value, we want to think of kind of the liquidating value or what that company will sell for. I'm going to pause for a minute and look up how Graham defines intrinsic value. I'm going to be referring to the interpretation of financial statements by Benjamin Graham and Spencer B. Meredith, so we can get Graham's definition of intrinsic value. On page 108 of the Interpretations of Financial Statements, Graham's definition of intrinsic value is the real value behind a security issue, as contrasted with its market price, generally a rather indefinite concept, but sometimes the balance sheet and earnings record supply dependable evidence that the intrinsic value is substantially higher or lower than the market price. This is one of the most important concepts to understand if you're focused on investing, because The comprehension of this is what's going to allow you to properly analyze a situation where you're going to buy stocks of a company where the intrinsic value or the liquidating value is less than whether it's what the company is truly worth or what the market is willing to pay for it. Now, as an investor, you want to be in a position where the company's intrinsic value is a lot more than what the market price or what the market is valuing that company for, because that puts you in a position to build wealth, because whatever the difference is between the market price and the intrinsic value is going to be how you profit from that stock. It's going to be the portion that you get above that market price if you own shares of that company. That's why it's important to properly conclude what a company's intrinsic value is. And like Graham pointed out, it's an indefinite concept. I think he was trying to say you're not going to get a spot on price where you can say, okay, Walmart is worth exactly 250 billion. But if you get around that ballpark and you notice that the company's revenues and all its other assets is more than what that market price or that market value is, that puts you in a position to buy those shares that are undervalued. And when the market recognizes that value, or when the company sells closer to that value, then you benefit because your shares are worth more than what you bought them for. That's really the key concept behind a margin of safety and intrinsic value. To go even further, I'm going to be referring to Warren Buffett's Ground Rules, a book by Jeremy C. Miller, because it kind of goes in depth on how to look at financial statements. On page 130, starting from where it says Chapter 43 of Securities Analysis, set up the basis for this method perfectly. According to Graham, a company's balance sheet does not convey exact information as to its value and liquidation, but it does supply clues or hints which may prove useful. The first rule in calculating liquidating value is that the liabilities are real, but the value of the assets must be questioned. This means that all true liabilities shown on the books must be deducted at their face amount. The value to be ascribed to the assets, however, will vary according to their character. For the liquidation plays, Graham advised, as a general rule of thumb, ascribing 100 cents on the dollar to cash, 80 cents on the dollar to receivables, 67 cents on the dollar for inventories, with a wide range depending on the business, and 15 cents on the dollar for fixed assets. Now, using that example I just read, and then going back to Walmart's financial information on the CNBC app, we see that Walmart's revenues is $484 billion and their market cap is $213 billion. So that's the revenues is more than double the market capital. Now, that's a significant factor. I mean, we haven't looked at the liabilities and things of that nature. I'm sure that difference would shrink, or that margin of safety would shrink. But just focusing on those two areas, you know, just to kind of get a simple concept of how we would start to look at liquidating value and start to determine if there's a margin of safety, we see that this is a very beneficial situation for an investor. If Walmart has no liabilities, then that is a huge margin of safety, which is more than 50%. I'm going to have to do a continuation of this video. I like to try to keep these videos short, but just to build on the concept of margin of safety and intrinsic / liquidating value, so that if somebody is interested in being an enterprising investor, they can not only get the right material, but they can start approaching the analysis from the standpoint of how to correctly analyze a company's value. So stay blessed and stay tuned for part 2.